Good morning. Today we aren't just looking at numbers, we are looking at a fundamental shift in India's economic social contract. As we enter 2026, every salaried citizen stands at a crossroads. On one side, we have the structural reform of the 8th Pay Commission. On the other, the fiscal policy of the union budget. Together they will determine your real purchasing power for the next decade. Let's decode the story behind the statistics. To understand where we are going, we must understand the cycle. Since the 1940s, India has revisited its pay structures every 10 years. The 7th Commission served us well, but inflation is a relentless tide. As of January 1, 2026, the old era has officially ended. We are now in the transition window, where the government must balance the aspirations of over 1 crore employees with the reality of the national deficit. You've likely heard the term terms of reference. Think of this as the rule book for the new commission. While the official report is a work in progress, the mandate is clear: neutralize the inflation of the last decade. This isn't just a gift from the government. It is a necessary calibration to ensure that the backbone of our administration, our public servants, can maintain a dignified standard of living. Now let's talk about the fitment factor, the multiplier that changes lives. In 2016, we saw a factor of 2.57, but the economic climate of 2026 demands more. We are looking at a proposed multiplier between 2.86 and 3.00. This isn't just a random number. It is calculated to bridge the gap between current market wages and government scales. A 3.0 factor would represent the most significant jump in basic pay we've seen in recent history. Look at these projections. If the 2.86 factor holds, a level 1 entry-level position, the very foundation of our bureaucracy, moves from 18,000 to over 50,000 rupees. At the higher end, level 10 officers will see basics crossing 1.6 lakhs. But as a professor of economics would tell you, nominal income is an illusion. It is the net that matters. And that brings us to the taxman. There is a common misconception about dearness allowance. As we move into the 8th Commission, your DA, which likely crossed 50% recently, will be merged into your basic pay. This resets the DA to 0%. Why? To simplify the calculation of HRA and other allowances. It's a clean slate, ensuring that future inflation adjustments start from a higher, more stable base. While the Pay Commission sets the floor, the union budget sets the ceiling. The finance minister's briefcase this year holds the answer to one vital question. Will the government let you keep what the commission gave you? Historically, pay hikes are often followed by bracket creep, where higher salaries push you into higher tax percentages. Recall our current landscape. The new tax regime is our default. We've seen the zero tax threshold climb to 12.75 lakhs for many. It was a masterstroke for the lower middle class. But for the mid to senior level employee, the 8th Pay Commission creates a new problem. It pushes you into the efficient frontier where tax planning becomes mandatory, not optional. One of the primary tools in the budget's arsenal is the standard deduction. Think of this as the cost of earning. In 2026, we expect this to evolve. Moving from 75,000 to 1,000 rupees isn't just a tax break. It's a psychological win. It acknowledges that as salaries rise, the cost of professional upkeep, from transport to technology, rises with it. The most debated topic in my circles is the 30% wall. Currently, once you cross 24 lakhs, the government takes nearly 1/3 of every extra rupee you earn. With the 8th CPC hikes, thousands of officers will hit this wall for the first time. The budget 2026 must address this by pushing that 30% bracket to 30 lakhs, or risk disincentivizing our most skilled workforce. Let's address the arrears paradox. If the implementation is delayed, you receive a lump sum. To a student of finance, this looks like wealth. To a tax auditor, it looks like a target. Without the protection of Section 89(1) of the Income Tax Act, your arrears could be taxed at the highest possible rate. It is the ultimate lesson in timing the market versus time in the market. We often debate old versus new. By 2026, the new regime is no longer just an alternative. It is becoming the ecosystem. For the government employee receiving an 8th CPC hike, the new regime offers simplicity. Unless you have significant liabilities like a high-value home loan, the mathematics of 2026 heavily favor the streamlined path of the new regime. We must not forget the 68 lakh souls who have already served. The pay commission is their lifeline. The proposed increase in minimum pension to 25,000 rupees is more than just a fiscal entry. It is a statement on how we treat our elders. The budget's role here is to ensure that healthcare benefits and tax exemptions for seniors keep pace with these raises. To summarize our lecture, 2026 is a year of the great calibration. Your basic pay is going up by 25 to 30%. The DA is resetting. The budget is likely to cushion this with higher deductions. If these two forces align, you will see the largest increase in discretionary income in a generation. If they clash, inflation will be your silent partner. The final grade for your finances in 2026 depends on your preparation. Watch the budget speech not for the headlines, but for the fine print on the slabs. I hope this deep dive has given you the clarity to plan your year ahead. Stay informed, stay prudent. Do you have questions on the fitment factor calculations? Leave them below. Class dismissed.